Good evening, family, and welcome to another installment of your Wealthy Wallet Wall Street course. Man, I hope y'all had a great week. As again, man, we do our things on Saturdays because while everybody's partying and trying to do their thing, we learning how to increase our wealth. We learning how to align our pockets. We learning how to build generational wealth so our family don't have to struggle. That's why we here sitting on a Saturday learning how to do these things. And last week we talked about how to read a financial statement. Now we're going to talk about how to analyze that same exact statement. Now that we know how to read it and or understand it in some way, now it's time that we learn how to analyze it, learn how to figure out what is this data telling us? What is this saying to us? I mean, now that we know how to read it, and if you don't know how to read it, I want you to watch the video over and over and over again till you completely understand how to read a financial statement, because a financial statement is very imperative not only to read another company's business, but also when you want to start your own business, because a financial statement is basically your report card. It's your report card in life. It's your report card if you want to become an entrepreneur. It's your report card in building your own business. Learning how to read a financial statement is imperative, period. No, nothing else said. You got to learn how to read a financial statement. If you don't, come holler at your boy, right? And let's learn how to read a financial statement. Now, let's learn how to analyze it. I want to talk to you about how to analyze a financial statement today because it's an instrument that we must learn how to use in order to properly evaluate companies, right? In analyzing a financial statement, there has to be a standard of comparisons. So when conducting a financial analysis, there should be a benchmark for comparisons. A current benchmark is an intra-company comparison which uses the prior year or years of of a same company as a benchmark. So as a benchmark, I know that in 2017 we were bringing in 50 million in revenue. So now let's take a look at 2018. Then 2018 we brought in 55,000 in revenue, right? So and then 2020 we brought in 60 million dollars in revenue. So we see these benchmarks as our own personal self as a company. We see where we are and where we strive to go, right? You In our own life we should have personal benchmarks, for growing, for becoming better, increasing our knowledge. Every quarter you should be reevaluating yourself, figuring out, okay, this is how much I've learned in the last 3 months. This is how much I increase in health. This is how much I increase in knowledge. This is how much I increase in business knowledge. What did you do over the last 3 months? Because we need to evaluate ourselves based upon every quarter, right? Because that's how you begin to set benchmarks. Okay, I know that I didn't do anything here, but I know that the next 3 months I have to dramatically increase myself in these areas, and these areas. I got to make something happen. There's got to be a standard of comparisons. There's got to be a benchmark for your own self. And then after there's a personal benchmark, you have to do benchmark in comparisons that is in comparisons to other competition. How's the other people in the same field doing? Are they doing as good as me? Am I doing better or am I doing worse than they are? See, these are benchmarks. These are basically starting lines or lines that tell you where you probably should be. If you and the company have the same product and the company down the street is making twice the money you are, you must find out what's going on. How am I going wrong? If the company down the street has double the amount of customers you have, then you have to figure out, what am I doing wrong? Why can't I get the same amount of customers? Is their product better than mine? I mean, is their marketing thing better than mine? How's it working? You need to take a look at the competition, because this helps you to set your own type of benchmarks. If everybody's outselling you and you're selling less than everyone else, why are you coming last? You got to find these things out, right? And then the final benchmark in industry standards is average. Often industry benchmarks can be obtained from financial websites, right? So long story short is, okay, if everybody's making about $20 million in their business, everybody's doing $30 million. Am I doing $1 million in my business? And somebody in the same field as me are doing, 1.2, another person's doing 980,000. We all doing about an average of what is expected in this industry. But if I'm way below average of what I'm doing in my industry, then I need to figure out, what am I doing wrong? If I'm above average, then I need to continue to study myself and continue to reinvent, right? Because I always want to continue to grow. And other companies are going to start looking at you and trying to figure out how you're doing it way better than they're doing it, right? We got to have benchmarks in life, period. We got to have a standard of comparison. So when we're looking at companies, we look at where they were before, where they were 5 years ago, where they were 3 years ago, where they were 2 years ago. This is how you begin to analyze a financial statement. And then you look at the competition. Are they kind of in line with the competition? If I have, three different software companies and we all making about the same money because we all do the same thing, or if I'm one of those companies, I'm super far behind the other two companies that do a similar thing to me, then what's really going on? Do I got bad management? What's happening? And then the bench, am I average of all my big brothers or all the people in my industry around me? Well, I mean, what's really going on? This is what financial statements help you to be able to see. So with that being said, understanding the nature of financial analysis is very, very useful in investing. Understanding a company's income statement, their financial positions, their statement of cash flow, and a statement of changes in equity with current and prior year data for comparative purposes are a starting point for anyone looking to do an analysis into any company or into anything, even in your own personal life, right? But there are three ways to analyze a financial statement. There's a horizontal analysis, which is the comparisons of a company's financial results across time. Some of y'all like, bro, I don't know nothing you just said. Don't worry about it. I'm gonna break it down for you. And then our vertical analysis, which is a comparison of financial balances to a base account from the same company in or compare against another company in the same industry. Bro, like I said, I don't know what you're talking about. Don't worry about it. I'm gonna break it down for you. You're gonna completely understand everything. You're gonna completely, when finished watching these videos, you're gonna completely understand how to break down a financial statement. And we're gonna do a ratio analysis, which compares the different balances from financial statements. Ratios are grouped together to assess a company's profitability, ability to pay debt, and survive in the long run, right? So we're going to learn all these things. We're going to learn if the company is able to survive in the long run. We're going to learn how they look in comparisons to their self over a period of time. We're going to start and we're going to look how they look in comparisons to other companies and the competition that's around them. We're going to learn how to properly assess a company value because we need to know a company's value, right? Because at the end of the day, you're investing in them because, you are investing in them because you see an opportunity to make money. So if the company's not going to make money, then why should you invest? You want a return on your income, right? ROI, you want a return on income. This is why you invest in the stocks. This is why you invest into the market. You want to see your income grow, right? And as a part owner, you want to make sure these people are making money for you. If they're not making money for you, then you need to go find somewhere else to dump your money. But in order to properly evaluate if they are going to make money in the future, then we need to learn how to properly analyze a company in a correct way, right? So we're going to start off with horizontal analysis. Horizontal analysis changes in account, it shows the changes in accounts occurring between years, which we're going to break that down. We're gonna really do an Excel spreadsheet because you got to put this on an Excel spreadsheet. Typically, horizontal analysis typically conducted on both the balance sheet and the income statement, and that's something we learned about last week. We learned on the financial statement what the balance sheet was, and we learned what the income statement sheet was. If you don't know, go to go to the class last week. Last week, I go over the financial statement and I'll teach you what a balance sheet is, help you to understand what a balance sheet is. And I break down each section of that balance sheet and I help you understand what an income statement is. So if you don't understand what these things are, I suggest you start right now and go watch last week's video because you have to understand those things in order to move on. And then lastly, the analysis helps us to calculate both the absolute and percentage change in each account balance on a financial statement. So what are you talking about, Donnie? I'm talking about that it helps us to form trend analysis by taking at least 2 or more years of data and analyzing it. And I'm going to show you how we're going to do that over a cross period of time. And by being able to recognize trends, right? Trend analysis can be used to build prediction models to forecast financial performance. That's what trends help us to do. Because if we understand past behavior, then we can kind of predict future behavior because future behavior will always be predicated upon past behavior, right? So we need to see, is the company trending in an up trajectory or are they trending in a down trajectory and why, right? Trend analysis can also be used to identify problem areas by looking for sudden abnormal changes in accounts. And we're going to talk about a lot about abnormal changes in accounts, right? So before we go on, let's go ahead and let's dig into. I want you to go to let's go to Yahoo Finance. Let's go to Yahoo. We'll go to Yahoo Finance. Yahoo.com. We'll click on the finance tab. Remember, this is free. Type in Apple, because we did it on Apple last week. The financial analysis, learn how to read Apple's financial statement. Let's continue to use that company. And if you want me to break down any company for you, just holler at your boy. Just DM me. Let's go to financial statement. My computer's running slow. Come on, Mac. All right, so now we'll go to the financial statement, right? And then we click and we go to Google. Go to Google real quick. Then I want to access Google Drive. Then I want a new document on Google Sheets. That way, if you do not have Excel, the Microsoft one, Google allows you to use a free one. So you need to use the free one. So let's call this AAPL Financial Analysis. So we're going to call this Apple's Financial Analysis. So we're going to first start off by doing horizontal analysis, right? I'm excited. Are you excited? I am. So let's do a financial analysis on Apple. Remember, first you're going to take the current cost. We'll take how much money they're making, how much, copy that, boom. Then you're going to put it right here. Hold on. Before we do that, let's type in, we need to know total revenue because we're about to do an analysis, right? So total revenue. We need to know total revenue. Let's stretch this out a little bit more. Total revenue. We need to know total revenue. We need to know cost of sales. We need to know that. Let's put that. This got to be in the middle too. So cost of sales. And we also need to know. Damn, how did we do that? Hold on. Total revenue. Cost of, right here, you want all these things, cost of sales, and then you want profit. So boom. I'll make this a little bit bigger so everybody can see. Make sure you're properly seeing this. 18. There we go. We're going to call this one horizontal analysis. Make this one kind of big. This is our horizontal analysis. Stretch this out a little bit more, stretch it out a little bit more. And then we want to, so I'm going to type in 2020. We need the data from 2020 and you need the data from 2019. So you need the data from 2020 and the data from 2019. So look, so right here, we're going to go back to Apple. We're going to copy this. We're going to first copy total revenue. So put the total revenue in there. And we want to put it in less zeros. And remember, everything are calculated in the millions. So this is $274 billion Apple brought in revenue. Okay. And the cost to bring in $274 billion was $169 billion. Again, remember, we talked about this last week on the financial statement. So the total revenue, the total money that Apple brought in was $274 billion. The cost to bring in $274 billion was $169 billion. So they netted what in profit after the cost of their products. So boom, so they netted $104 billion. So Apple made $104 billion in 2020. Woo, Apple's making some bread, ain't they? All right, so in 2019, they made $260 billion. Paste that there, we'll go back, and then the cost to make $260 billion was $161 million. I mean, it's 161 billion. And then they made in profit $98 billion. So they gross $98 billion, and we go and paste that there, right? Just like there. And oh, guys, I want to highlight this real quick. I'll put bars around this. Boom. Okay. So the total revenue, we got the total revenue for two, and we got the total revenue, total cost of sales, and profit for 2020 and 2019. And so what horizontal analysis helped us to do is we want to know first the change. We don't know the change, the money change, right? Sorry, I put all these in the middle, 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 middle. Okay, we want to know the change. So we'll easily do the change. All I do is right here, where's you start with your base year first, right? I mean, I'm sorry, you start with the 2020 first. So 2020 is in C row and seventh column. So C row, seventh column, right? So C row, seventh column. So C row, C row, seventh column minus, what is this one in? This one's in the D row, seventh column, right? Just in case you don't know how to do an Excel sheet. I forgot to put equal first. We got to do equal. You see C7 minus D7. And that will give you the calculation. So 14 billion. And you just take your, 14 billion. There's a change in 14 billion. Take your arrow and pull it down like that, and it automatically counts those for you. Let's make these a little bit bigger so we can see these numbers more. 14, and there we go. All right, so we got that, and then now we want to know the ratio. We want to know in percentage. Okay, Apple made $14 billion more in 2020 than they did in 2019. And the cost of sales went up $7 billion. And then they made a profit. They made $6 billion more in 2020 than they did in 2019. So what is this telling you? This is why we do these financial analysis, right? What is this telling you? Apple, remember, what was last year? Last year was the start of a pandemic, right? If last year was the start of a pandemic, and in a pandemic, year over year, Apple made $14 billion more in a pandemic than they did in a year there was no pandemic. So what does it tell you? Apple is surviving. Not only are they surviving, but they are thriving, right? This is an amazing, stupid, amazing company. They were able to make $14 billion more in a pandemic than they did before pre-pandemic. So it told you how beast of a company is, right? Apple. And by them being able to make $14 billion, they only literally paid $7 billion more in cost of sales. They only paid $7 billion more to produce more products. So literally they doubled their money. Doubled. And then what it tells you in profit, they was able literally to make a $6 billion profit. $6 billion profit in the pandemic. They made $6 billion more. So they brought in $14 billion more in revenue. What that also tells you, right, is if they're going to bring in $14 billion more in revenue in a pandemic, it shows that their products are what? In demand. It's in demand. Their products are highly in demand. If they increase their sales by $14 billion in a pandemic, it shows that not only do they know how to survive or know how to thrive, it shows the demand for their products, right? So you want to understand those things. As an investor, I want to understand that the company that I have fractional ownership into, people have a demand for our products, right? So it shows you that people have an extreme demand for their products in a pandemic. Not only out of a pandemic, but they have more of a demand in the pandemic, right? And my cost of supplies really didn't go up much, right? Because I was able to double my money on the cost of the products. So I want you to pay attention to this. When you look at this statement, you need to think about all these scenarios, right? Okay, so what if Apple actually lost money? What if they lost money, right? Instead of making money, they lost money, right? Let's say they lost $20 billion. So instead of it being 260 billion in 2020, what if that was 240 billion, right? That would have been justifiable in a pandemic, right? That would have been justifiable in a pandemic. Of course, their cost of sales went down because we are in a global pandemic. People are scared. People don't want to purchase anything. People want to hold on to their money. They don't know what's going to happen, right? So that would have been justifiable. But what if they lost $20 billion and it wasn't a pandemic last year? Then guess what that raises? A red flag on the play. Why are the demand for our products going down? Or why are we selling less? It might not even be the demand. Why are we selling less? What are we doing wrong? Right? What is the company doing wrong? You want to know if they lost $20 billion in revenue, what happened? Because $20 billion is a lot of money to lose, right? But in comparative to what, right? In comparative to who, right? So, and why I'm saying that, that's why you need to know it's a loss of $20 billion, a lot for Apple. So you want to know that, right? So that's why you're going to need percentage, because we don't know that. And according to percentage, what is that a percentage to what they've been doing, right? So this is what you do. Now we want to see the actual margin, right? So you're going to take right here, E. You want to take the change, which will be, remember, you always got to do the equal sign. I almost got to do the equal sign. So you want to take E and change this in E7, right? And divide that by the base year, which was 2019. So boom, 2019 is in D, what, 7, right? And then we want to change that to percentages. Then remember, we want to take it and drag it down so it formulates all of it. So this gives us a percentage. So an Apple was able to increase their profit year over year by 5%, which is pretty strong, right? Considering they're already a billion-dollar business, a multi-billion-dollar business, and they continue to grow. They're the first $1 trillion business, $2 trillion business, and I believe they will be the first $3 trillion business. So Apple is definitely an amazing investment, an amazing company to invest in. I love Apple. So year over year, it shows me they went up 5%. This is a good number because look what happened. And all during that period of time, their cost of sales went down, right? It was only 4.8 cents. And then you look at this, their profit increased by 6.67% over that time. Apple's doing truly amazing. When you say that, so a taper. So when you're looking at a vertical analysis, I mean horizontal analysis, it helps you to evaluate these things. Let's look at the search change. There was a 5% change year over year. It was good, right? Year over year. Check it out. They only went up and the cost by 4.8%, but going up by incurring a 4% more cost, they were able to make $14 billion. So if I have to increase my cost by 4%, 4% to make $14 billion, let's go. This is what this helps you to understand. If they're able to increase their cost by 4% and made $4 billion, $14 billion, when you say that was a great investment or a great cost incurred, right, on your money. But what if they increased their cost by 80%, right? And was only to make 14 billion. And that probably might not be that great, right? What if they increased their cost by 80% and didn't make any extra money? Then that would be really bad. This is how it helps you to see and recognize what a company's doing, right? You got to know these things. So what if the cost of sales went, like we just talked about the cost of sales. What if the cost of sales went up, but the revenue went down, as we just got to talked about? Or what if the revenue went up and the cost of sales went down and profit went down? Hold on. What do you mean, Donnie? So what if revenue went up and the cost of sales went down? That's a good thing, right? But profit went down, because that wouldn't make any sense if the cost of revenue went up. I mean, if the total revenue went up, so they made more money, and it cost them less money to make more money. So how did they lose money? I don't understand. Help me to understand this. All right, because there's such thing as SGA, there's such things. Did they pay off more debt? Did it cost them more money to advertise? Did they pay out more money in commissions and bill? I mean, you got to look other places, right? Because we know they didn't make less money because they sold less. We know they didn't make less money because their products cost more. We know it has to be somewhere else. Maybe it's in the memo last week on the financial statement. We talked about the SGA, selling general administration, right? That is called, like, with the cost of the advertising, commissions, employment fees, bonuses, and things we do on a day-to-day to operate as a company. So we need to go take a look there to see, did this cost go up? I mean, what's really shaking? What's really going on? So when you know this about a company and you see a trend across the numbers that the SGA is continuing to go up, what's really going on? Are we on a bad management now? What's really going on? Why is all this increasing? Or they're hiring more people because they're about to dive somewhere else. Well, I don't know what happened. I want to know what's going on. Did they pay off a large amount of debt? Why did their profits decrease? I want to know. I mean, not did they pay off a large amount of debt, because that has nothing to do. But I want to know, whether they incur more cost to make less profit. That's a must know. That's why creating this chart helps you to analyze what's really going on. See, we created this chart in 5 to 10 minutes, right? We created this chart in less than 5 minutes. So now we understand what's going on. We know they made $14 billion more, right? We know it only cost them $7 billion more to make 14 billion. And we know that was only an increase of 4% over year, right? And they made $6 billion more than they made in 2019. So it helps me to understand Apple is doing their thing. But if they're making less, you need to figure out why, as we discussed. So now that we talked about horizontal analysis, now let's jump back and let's talk about vertical analysis. So when we look to compare companies of different sizes, then it's always going to be useful for us to be able to standardize the statement in a way, basically in a way to organize to see what's going on vertically. Just like we just did a horizontal analysis. Now we're about to do a vertical analysis. And a vertical analysis, it just really allows us to be able to compare a financial statements of different companies and also the financial statement of our own company, right? Or of the same company after adjusting for the difference in size, right? So, but vertical analysis not only helps us to be able to analyze and compare a company's account balance within a 1 year period, it also helps us to be able to conduct both financial statement positions and the statement of income. So we're going to be able to properly annihilate it by dividing each account balance by a base account and yielding a percentage. The base account is total assets for statement of financial position accounts and net sales or revenues for statement of income accounts. You're like, Donnie, I don't get any of that. What are you talking about? So let's break it down what I'm talking about. So since we've already done a horizontal analysis, now let's do a vertical analysis. So we'll type in vertical analysis, right? Vertical analysis. Don't want to make it bold like we did the other one, because this is a part of your daily work. Then we want to copy this part right here. Want to copy, see the whole highlighted boxes. Bring it down here because we're about to use the same numbers to do a vertical analysis. We just use these numbers to do a horizontal analysis, which is across. And we're about to use these numbers to do a vertical analysis, which is up and down. So let's go. Let's highlight this part. Let's put this. Boom. All right. I want to move this one over. Boom. All right. So we move that over. And then in order to do a properly vertical analysis, we need the percentage just like we got it here. We need it here, right? So let's go ahead and do it. So we type in, in order to do a perfectly vertical analysis, then we got to type in revenue divided by revenue. So we're going to take, what's this, row C, column 18, row C, column 18. So C, first we got to type the equal sign, then type in C18 divided by C18, which is always going to be 100%, right? Ends up as 1. We want to make it bold. We want to make it at least 14%. And we want to turn that into percentages, right? Same thing. Then we just slide it down here. So we continue to create the calculation for us. We'll go up here and change it, right? Change this to row 18. And that to 19. See what I'm doing? What I'm doing is you got to be able to divide the cost of revenue by, the cost of sales by the total revenue. So what you got to do is divide the cost of sales by the total revenue. That's what we're doing to get that percentage, right? Boom, 61%. Do the same thing here. We want to divide by 20, cost of sales by revenue. We'll get 38%. Same thing, you just take this one, copy it. Boom. So now it does it for you. All right, so what does this tells us as we do this analysis, right? We take this analysis on Apple, right? This vertical analysis tells us, okay, so in 2019, it was the cost of sales was 62% of the revenue generated, right? And then in 2020, the cost of sales was 61% of the revenue generated. So what it tells us, that the cost of sales went what? down. So now we get to see. So it tells us the percentage or the margin of the cost of sales. Right here, it tells us that the cost of sales actually went down, right? And it not only tells us the cost of sales went down, if we continue to do an analysis, it tells us what? That profits went up by a little bit by 0.5%, right? Profits went up by 0.5%, right? It didn't go down by 0.5%, it went up by 0.5%. And it tells us that costs went down, right? So what happens if these numbers change? What happens if the profits went down by 0.5%, by 10%? Say the profits went down by 10%. Then we want to, that would throw a flag, right? So if this read, 28 instead of 38, we want to know what happened, right? Why did their profits go down 10%? And of course, you want to know out of a pandemic. Of course, if their profits go down by 10%, that's still a lot, you know, but you can completely understand why, right? Because when the pandemic, and then we want to take a look at other companies and make sure they took a similar hit, right? Because you got to do in comparisons too, right? Okay. I mean, is a 10% increase bad or good? I don't know. It's in comparisons to what? You got to have benchmarks, right? As we talked about benchmarks. So when you look at this, we see Apple, instead of losing money, they actually made a profit. And then you take a look at the same companies in the same sector as Apple. Did they make a profit? If they didn't make as a big profit as well as Apple did, it shows you that Apple's ahead of the game and they doing their thing and they're making money. They're understanding how to make money even in a pandemic. They know how to pivot, how to change things up, how to go with the flow of times and be able to, chameleon their way into profits, right? They figured it out. They learned how to adjust and adapt in order to continue to grow even in a down economy, even in a pandemic. Apple is kicking butt. And not only that, they figure out how to cut costs. They figure out how to get the costs down of their products. They figure out a way to increase sales while also decreasing costs. So Apple, you want, as an investor and as an owner in a company, that's something you want to do, even in your own company, even in your own life. You always want to find a way to get rid of the weaknesses and figure out how to cultivate your strengths, right? In life, period, in general, and everything. This is how you got to look at life as a fact. You got to look at a financial statement as a part of life. And anything you do, if you can find a way to decrease your bills and increase your income, how much better would you feel? If you can make $1,000 more a month and decrease your bills by $1,000, that's $2,000 more in your pocket, right? This is why I want to explain this in certain terms. So vertical analysis is always a big plus to be able to do this, because you want to understand that, hey man, Apple's going in the right direction, right? Because if they able to increase their income, increase the money they got coming in, and tighten up on the money they got going out, then we understand that they're going in the right direction, right? This company, because at the end of the day, revenue and profits help drive a company. Without revenue and profits, the company will eventually go out of business. Because if you're not making, if you don't got a lot of money, if you got way more money going out than you got coming in, you're not going to stay in business for long, right? So this is how we do a vertical analysis, and we take a look at this and we break this down, and it helps us to understand what's really going on, right? We see, but Apple is trending. It's trending upwards, right? Horizontal analysis and a vertical analysis help us to understand that Apple's trending upwards, right? They're growing in revenue, they're lowering their costs, and their profits is going up, right? Because their profit in 2019 was 37% of revenue, and now it's 38% of revenue. So they're going up, right? They increased their margin. This is exactly what they did. They increased their margin, right? The profit margin went up. So we need to understand these things as an investor, that, hey, they got more money coming in and less money going out, which makes a good recipe for profit. Let me say it again. When you got good money you're increasing your money going out, and you decrease the money. When you increasing the money coming in and decreasing the money going out, that is a good recipe for profit, folks. That's what we call it. Holla at your boy. This is how we learn investing 101. This is how you learn to evaluate a company. This is how you learn to dig into the numbers. Man, they didn't teach us this in school. What if they would have taught us this in school? How much more smarter would we be if we could look at a company, fundamentally analyze the company, not only momentum trade and going with the times, but we able to break down a company like this? What if they would have taught us this in school? Because not only if we were able to break down a company like this, we can also apply it to other areas in our life. That we can generate a report card for our own selves. We could generate a report card for our own businesses or other people's business to help them completely understand the trajectory that their company is going on. So when we sit here looking at all these things, it help us as a business owner to understand where I'm going as a company if I decide to open a business, right? They don't teach you this in school. There's a reason they don't teach you this in school. It's because they all want you to remain factory workers. They all want you to remain employees and not employers. But here we're learning how to become an employer. We're learning to take our money, invest it to create more money, and then that more money continues to buy you more time and freedom. Because at the end of the day, it's all about time. You're buying time. You're buying freedom, man. You're buying your own time back. So you should invest to be buying your time back, right? To not being able, because whoever controls your time controls your life. So the more you are on a job, the more they have control of your time. They're paying you for your time and your knowledge and your skill set, but mostly your time, because your time, you have to do it. You have to put in the work. You have to be there, right? So if they would have taught us this, it would have freed us from them enslaving us. Because at the end of the day, we're learning how to play the same game that they play and that they teach their kids to play. Because once we know how to analyze a financial statement, it gives us the ability to know which companies to invest in. Because at the end of the day, it's all about making good decisions. And you can't make good decisions if you don't have all the information. And if you don't have all the information, then you become ignorant to what is going on. And if you are ignorant to what's going on, it is not bliss. It is hurting you. You're hurting. The less you know, the more you are hurting. The less you know about your business, the less you know about the trajectory of your life, the less you know about your health, the less you know about anything. It's not a bliss. It's not bliss at all. It's actually hurting you. So that's why I always try to teach, get the information, know how to read a financial statement, know how to put spreadsheets like this down together. That's why I'm breaking it down to you in the simplest terms. and and if you still need more explaining, just holler at your boy, just DM me. I don't mind explaining and breaking this down to you, because at the end of the day, once you know how to break down a company like this, you understand how to make money. You understand how they are making money, and you understand how the competition is making money, and you understand how to make well-educated decision. Because at the end of the day, life is a series of decisions from the time you wake up to the time you go to sleep. Your success in life is based on a series of decisions, right? And whether you're doing bad in life, it's also based on a series of decisions. So the better decisions that we can make, the better money that we make. And it's even in the company. Company pay you more, or people will pay you more for being able to help them make a decision, right? It's all about being able to evaluate and make proper decisions. The better you can make decisions, the better you are with deciding and making great decisions, the more money you're going to make in life, period. So if you gain more wisdom on how to make great decisions, that you're always making great decisions and everything that you do, it's going to pay you a lot more money in life. But decisions will always be based on information. So go out and get the information. Know how to read this financial statement. But let's continue to go. Okay, so now that we did horizontal and vertical analysis, now let's talk about profitability analysis of the financial statement, because it helps us to be able to, assess profitability through the calculation and interpretation of ratios, right? So we're going to create a couple ratios in a few seconds, and then we're going to go in depth of what those ratios means and how it help us to, and how it help us to evaluate a company's standing of probability, right? Probability is critical for a company's long-term survival. We need to know that they're making money and that they're going to continue to be around, 20, 30 years from now, right? Because if you see a company's profitability going down over a course of time, then you might think to yourself, this company might not exist in 20 years from now, right? So look at GameStop's profitability. If you look at if you do this ratio with them, you will understand that they will not be around 10 to 15 years from now. GameStop will not be around unless they are literally able to pivot in a big way. That's why I would never jump into GameStop. You can always catch me on the sidelines for that because I know at the end of the day, this is a company who is not creating any new equity. They're not generating profitability. They still operating in a dying model. I mean, CDs are becoming obsolete, right? You can all download. It's just like what happened in car. If you get in a car now, there's probably barely any CD players in cars, right? Because it's becoming obsolete. They got a dying business model. Unless they're able to switch it up and figure out a way to make some money, they're gonna be gone. They are literally gonna be gone. But profitability definitely is critical because it definitely helps us to be able to, access a company's critical survival of the future, right? It tells us a little about the efficiency and effectiveness of those profits. We need to know, right, about all that. So we're going. So in order to get that, we're going to have to discuss profit margin ratios. And what is a profit margin ratio? The profit margin ratio compares net income to net sales, right? And it measures the ability of a company to generate profit from sales. A higher ratio indicates a greater ability to generate profits from sales. In order to get this, we take the total comprehensive income, which is net, and divide it by net sales, right? The total cost, which, well, again, the money that they brought in, and we divide it by the cost, is how we get the net sales, right? And then we divide that by the net sale. And this, then we divide this and we get all these net sales, right? But no, we're not going to talk much about that one. So profit margins equals the comprehensive income divided by net sales, right? The money they brought in, right? And so then we're going to discuss return on equity. We're going to write all this down, and I'm helping you to understand it right now. I just want to go over the definitions with you. So, and all this is going to come together. I promise you. I like to break things down in a proper way. So let's talk about return on equity, right? Because we need the profits in order to get a return on equity. So the return on equity ratio compares profit, average balance, and shareholders' equity, showing how effectively a company uses the funds provided by the shareholders during a year to generate additional equity for its owners. So return on equity equals total comprehensive income divided by the average shareholders' equity, right? And then we look at return on assets. We're going to return on asset ratio compares income to average total assets, representing the ability to generate profits from its entire resource base, not just the resources provided by the owners, right? We want to see that they are literally being able to make money, not only on the money that we generated for them, but money from the assets that the business hold, right? So we want to make sure they're making money outside of just people just giving them money. They need to learn how to make money. What are they renting out parts of their building? Like because Apple has a huge building. They might invite other companies in there to take up office space so that they start making money on the assets that they hold. They might make money about leasing out certain services. So we want to make sure that they're making money on not just the income that they are giving, but also on the assets that they already have, right? And we determine the return on equity by taking the total comprehensive income and by the average total assets, right? And then return on equity, we take the beginning assets plus the ending assets and divide it by 2. That's how we get return on equity. It's supposed to be return on assets. The top one was assets and the other one was equity. I messed up on that one. I'm sorry. Earnings per share. Earnings per share. No, we're not going to go into that one yet. But let's go ahead and dig into creating this formula that we just talked about. All right. So let's talk about first how do we get return on equity? Let's go ahead and calculate that. Let's make this a little big. How we get return on equity? We need profit. Let's not make that too bold. So we need profit, open equity, right? Because they said we need open equity. We learn how to remember. Just go back if you forgot how we saw this, right? It's too big. It's lowercase sign of this. But it's profit thing. So we got profit, profit. All be the same. All right, so we got profit, and I'm gonna change that to open equity, closed equity, and then we need open assets, closed assets. And remember, I showed you how to calculate this on the PowerPoint. So if you need to figure out what I'm about to do, just go back and look at the PowerPoint because we have to be able to calculate the ROE, right? So now we go to ROE, ROE right here, right? So copy, I'll make it the same, because the same font, R, R, ROE, return on assets, right? Let's do this. Return on assets, ROE. All right, so in order to first to get the ROE, we got to get this stuff down. Get what's the profit they made. Boom. Okay, we get the profit. Apple made $104 billion, right? Open equity. So how did we get the open equity, right? Explain the open equity. Back again, back in the PowerPoint, and also if you will know exactly where it is too, if you watch last week's class, right? Last week's class. So pre-tax income, which is again the same. I mean, not the pre-tax income. I'm sorry. After pre-tax income, this is the net income coming to stockholders, right? Which is the bottom line the shareholders are entitled to, right? So we're going to copy that, right? Which is 57 billion, but we need to know the open equity, right? Not the close equity. This would be the close equity, right? Because this is where they ended the year. And usually when they open the year, open equity is where they open up the year. So it will be the close from the previous year. So they close from the previous year at 55. So they open up at 55 to 56, right? So this will be this open. 55 to 56 will be the opening for this year, just like 59 531 would be the opening for 2019, right? But the close, so they lost about $4 billion, right? And then 2019, we see the opening is 55 and the close is 57. So they made $2 billion, right? In equity. So let's write the 55 down in open equity. So they made 55. Boom. Make it big again. 55. Then we get the close equity, which is 57,000, right? Let's make it big. And then we get open assets. Again, if you did not listen to last week's video, I suggest you go there because you need to know all of this in order to find out where these things are. So we talked about open and close assets. So they closed assets in 2019. So the closed assets in 2019 was 338 billion. So it would also be the same as the opening of 2020, right? So we put that down here. Make it bold. And then we go to Apple and get the closed of 2020 because we're doing an analysis on the current year, right? On the previous year. Boom. This was 2020 because we want to see the company's trajectory in 2021, right? All right, so we got all these right. So now that we have open equity, we have closed equity, we have open assets, and we have closed assets. So now we should be able to calculate the ROE, which is return on assets, right? And the return on assets equals copy, profit, right? Profit divided by the average of the open and close equity. So what we learned. So now we got to create equals, type in average, right? Average. Then we need the open equity and the close equity, and boom. So we got that right there. Let's make it nice and bold. 14. Maybe accounting. Right, so we do that right. Not too many zeros. Let's get some right. So many zeros. Boom. Boom. Put him in the middle. I don't know why he's in the end. All right. So we do that right. And then in order to get the ROE, again, we're going to do what? Equals profit, right? So we're going to go profit equals E is in the E row and the 27th column. So E row, 27th column, right? And we got to divide that by the average equity, which is in the E row, 28th column. Boom. Gives us two. We don't want accounting on this. Percent. So it gives us 186%, right? Apples all the way up, baby. All right, now we're going to do the same thing for ROA, return on assets, right? Make it bold, big, right? Return on assets. Then we take the profit, copy, and we divide it by the average assets, right? So we go equal. We take the average assets, open and close. Oops, did something wrong. Equals average. Highlight these two. Boom. There we go. Bold. 14. And then we take this, right? We take the profit, right? Again, equals. We take the profit, which is in column E, right? And row 31, column E. So E31 divided by E, right? Because and then we got the average of assets in column E, row 32. I mean, yeah, row E, column 32. Sorry. Then we change that to a percent. We'll change it to percent. Make it nice and bold. And it goes. So what this indicates to us, let's take a look at this. So Apple's making money on a return on equity. And the only way they can do that is by managing their return on assets pretty well. See, if you can't manage your return on assets pretty well, then you cannot continue to create equity and you cannot continue to make more money, right? So the return on equity is pretty good because it's showing that they're making more money. Because look, you got to understand something. Whatever's not assets is liabilities. So they have another 69% in liabilities, right? 68.7% in liabilities, right? The rest of it, 70% in debt, right? In liabilities, I'm sorry. And the other 31% in assets, right? So the farther they increase this, the more this goes up. You want this to go higher because that shows that the less assets, the less return, the more return on your assets, and the less taken out of liabilities, right? And then we see their return on equity is 186%. So they show me that Apple is doing really good. But what if this But what if this was negative 50,000, right? What if this was negative? What if it was negative 500,000, right? Okay, I did the wrong one. I didn't mean to do that one, folks. Come on up out of here. So let's say negative 50,000, right? So it went down. So they lost 8.8% in the money that we gave them to make money. They lost 8% of our money, which is a big loss. If a company lose 8% of your money on a return on equity, hey, red flag, pal. What's going on? You're not leveraging enough from the owners to help you make money, but instead you're losing money. So we're giving you money just to continue to lose. And whatever return on assets was down, whatever return on assets was also the same, right? Let's say negative $50,000. So I have so much debt that I'm leveraging, right, to buy assets that's costing me even more money. So I have so much debt and liabilities that I don't have the ability to make money. This is why it's big to pay attention to these things, right? It's very big to be able to pay attention to the debt that the company is accumulating so that you know exactly what's really going on. But we see Apple is creating, they're making money on the equity that we gave them, right? They're making money on the money that we invested, and they're making money on the assets that they bought that when we gave them money to invest into, they made more money out of it, right? But on their assets. So it's help us to understand these things. So this is a beautiful thing that we're learning to understand, right? Because we know that the company's taking our money and making money. So that is something definitely that we need to always pay attention to, because at the end of the day, man, we see that Apple is really a complete beast, right? The Apple is a complete beast. That's what I wanted to show you. But next week, we're gonna continue to ride this thing out. But next week, we're gonna go over more like the EPS and the earnings and learn what multiples are. We're gonna do all that, but I don't want to take you any longer. But just wanted to show you just a simple breakdown of a financial statement. But we got part 2 and 3 coming up too, because it's going to take a little the next the next 2 classes to be able to properly know how to really analyze a financial statement, because we need to know all these things like the total revenue we see. And this is in real time, real data, right? This is real time. We're seeing what's going on with Apple in real time. We know they're up 5%. We see they're making money. Their cost of sales went down, right? Their profit went up. We're seeing all these beautiful things. They're making money on the money that their shareholders provide to them, and they're making money on the assets that they have, right? So everything's up. I know they made 31.69% on the assets they have from the previous year. So, hey, we're doing good, Apple. Continue to get your hustle on, man. Your books look real good. And we can always do this for any company, man. Holler at your boy, and I'll help you. We can go on live and break down a real financial statement, right? On live in real life time, however y'all want to do it. But if you find this information to be valuable, please do not forget to hit that subscribe, that like and follow button, because again, I do this for free, and I do this to help people increase their knowledge of a financial statement in order to increase their decision making, right? Because the better decision you can make on the companies that you jump in, it's going to make you money. And the more money you make, you can go and help other people like I'm helping you, how I got the time to be able to do this for you. So please do not forget to subscribe, hit that like and follow button. And again, I can't wait to see y'all next week to go over my favorite part when we talk about earnings per share and price to earnings, which helps you really, really figure out from what a company's about just right at a glance, without even opening our books. You can see at a glance that this might not be a good opportunity, or this might be a great opportunity. Let's look at the book. So many things that we'll be able to figure out. But I hope you have enjoyed this episode. And we will continue the next week as we go over EPS and price to earnings, right? Thank you again. Hope you enjoyed the horizontal analysis and vertical analysis. And I will see y'all next week, same time, baby.